Hello, YouTube, and thanks for tuning in to the next installment of All Things Trading, the multi-part series that promises to teach you everything you need to know to master the financial markets. I have attended all of the classes, all of the courses, even the fancy online trading school, spent all of that money so you don't have to. And I will pass along all of the information and knowledge that I've acquired to you absolutely free right here. So be sure to subscribe. What will we be talking about today? Shorting a stock. So what's on the agenda for today? Well, we're going to talk about what exactly does it mean to short a stock, how to execute a short sale, and the benefits and the drawbacks to doing so. So what does it mean to short a stock? Well, when you're shorting a stock, you are borrowing it from your broker, then selling it at the current market price, buying it back later at hopefully a lower price, and then keeping the difference. Make sense? Say this is you, and you happen to know a guy who's in the market for a watch. We're going to call this guy Jake. And Jake says that he's got $25,000 for a Rolex, an 18 karat day date with a champagne dial and stick markers. And 25,000 is happens to be what they're going for. But you happen to know on good authority that a week from now the Rolex store is going to be selling that very watch for 20,000. But Jake, he wants his watch today. But you know a guy. You know a guy who happens to have the very watch that Jake is looking for. So you call your friend and you say, "Hey, can I borrow your Rolex for a few days?" And he says, "Sure, no problem." And he lends you his watch. So you call up Jake and you say, "Great news. Got that watch you were looking for." And Jake says, "Yes." You sell the watch to Jake for the $25,000 that he was willing to pay for it. Now you are $25,000 richer. But now Ben wants to know, "Where's my watch at, bro?" And you say, "I'm going to have that for you tomorrow." So now you run down to the Rolex store where all watches are on sale, and you find that very same 18 karat day date with champagne dial and stick markers on sale for $20,000. You give them the 20,000, the store in turn gives you the watch. You then meet up with Ben to give him his watch back. He is happy to have his property back, and you, because you were able to replace his watch for $5,000 less than what you sold it for, you, my friend, are $5,000 richer. So how is this applied in the stock market? Well, your broker, whether that be TD, E-Trade, Robinhood, etc., they all carry an inventory of stocks. And the exchange, whether that be the New York Stock Exchange, the NASDAQ, etc., that is where you will find the current market price for those stocks. Now, of course, this only works if the future price is lower than the current market price at the time you decide to execute this plan. But if you have it on good authority that XYZ company's stock price is going to go down in the near future, you can always short the stock. And here's how it works. In order to wrap your head around how this works, you have to understand that you are borrowing the property, not the money. So if you want to short 100 shares of XYZ company, you're going to be borrowing those 100 shares from your broker. You are then going to sell them on the open market for whatever the current market price is. And if that happens to be $200, you sell those 100 shares on the open market for $20,000. A week later, the prices drop to $150. You now have the opportunity to buy back those 100 shares for just $15,000. And if you do that, you get those 100 shares back from the open market, returning those 100 shares back to your broker, making them whole. Remember, all the broker wants is their 100 shares back, regardless of what the price is. And because you were able to sell them at $20,000 and buy them back at $15,000, well, you just made a $5,000 trade. Now, of course, there are interest and fees and things of that sort that are going to be deducted from your profits, but you get the idea. Shorting a stock is great for a couple of reasons. Number one, it allows you to profit when the stock price goes down. And secondly, you don't have to own the stock. But what if you're wrong? Say you've borrowed your 100 shares from the broker. You sell them on the open market at the current market price of $200 a share. You get your $20,000, but it turns out that you were dead wrong about the price. Instead of it dropping to $150 a share, it skyrockets to $300 a share. Well, now that's going to cost you $30,000 to buy those shares back. Well, what do? If you close your position out now, you're looking at a $10,000 loss. Now, you could wait and see if the price comes down, but then you run the risk of having that $10,000 loss quickly become an $11,000 loss or greater. And that's not the worst of it, I'm afraid. Remember this guy, Ben? Well, Ben at any time can say, I want my watch back. The broker reserves the right to reclaim the stocks whenever they want. So waiting for the stock to go back down may not even be an option. And if by the time the broker says they want their stocks back and you don't have the money to buy back the 100 shares that you borrowed, they can liquidate your entire portfolio. So the Boeing stocks and the Lockheed Martin stocks that you've been holding forever, hoping that the dividends were going to supplement your retirement, yeah, that will all be gone. Not to mention the various fees that are associated with shorting a stock. There will be interest that will be paid while you are maintaining a short position. You'll be responsible for paying any dividends that the company would otherwise be paying out while you are shorting their stock. And remember, I said your broker has an inventory of stocks, and of course, not all stocks are in that inventory. So if there's an organization that you're wanting to short, depending on how difficult it is for your broker to acquire those shares, well, there's going to be some fees associated with that as well. The bottom line is that the potential loss is unlimited when you're shorting. If you're buying a stock and you put $1,000 into XYZ company, well, the most you could possibly lose is $1,000 if the company ends up going to zero, which can happen depending on, how strong of an organization you're investing in. Is extremely unlikely, but could happen. So when it comes to shorting, you better be using a stop loss. Let's take a look at this example. It's the 19th of February, and you just took a short position in XYZ company at $104, right there. And the very next day, the price gaps down. Good for you. Everything's looking good. By the time the 23rd arrives, XYZ Company has seen a new low of $99.93. You have the opportunity to close out your short position and make a $4.07 per share profit. But the next day, the price closed at $104.38. There went all of your profits just like that. Now the 25th rolls around and you can breathe a slight sigh of relief because the price is starting to come back down, closing at $103.47, which you close your position out now, it's essentially break even. But in a couple of more days, you should be good. Psych, just when you thought everything was lining up for you, the price is now closed at $108 per share. Now you are really effed. But a simple stop loss at 105 could have prevented this catastrophe. So how do you actually execute a short sell? Well, remember our online order form in the action section where we previously discussed where you would select either buy or sell. Well, in this circumstance, you would select sell short. And all the other fields remain the same as far as quantity being the number of shares you wish to short, symbol being the company that you wish to short, and order type. Remember, order type is how you want your order served up to you, whether that be a market order or a limit order, or whether or not you wish to implement a stop loss. See my other video on how to buy a stock for more information on that. But in this case, it'll be a limit order, and because it is such, we will select the price that we wish to execute the trade, and the time in force being how long we want the order to be good for. Now, when shorting a stock, a couple of things you need to keep in mind. First, in order to do it in the first place, you're going to need a margin account. If you have a cash account, forget about it. It's not going to happen. So what's a margin account? A margin account is a type of an account you set up with your broker that allows you to purchase stocks with borrowed funds, or more commonly referred to as credit. And not all stocks are shortable, if that's even a word. But no matter how confident you are in the direction of a particular stock, you may not be able to short it at all, and that's just the way that it goes. Now, the logistics on how to execute this, depending on the platform that you're using, may be slightly different. So I'm also going to show you how it's done in the Thinkorswim platform. So here's what the order form would look like on the Thinkorswim platform. And right here, where you see the selection for side, you would select sell. And in the quantity, instead of it being plus 100, which is what you would be selecting if you were buying, it would be minus 100 shares. And everything else, again, self-explanatory, what company it is, the limit price, the time in force, and so forth. Well, that is it for today. You are one step closer, friends, to becoming a master of the financial markets. And you now know what it means to short a stock, how to execute a short sell, how it helps you, and how it jams you up too. And I know that this can often be a confusing topic, so please, by all means, if you have any questions about the information that was covered in today's video, leave them in the comments below. Or if you felt that I missed something, leave that in the comments too. You're not only going to be helping me, but you'll be helping others who may be coming across this video too. Thank you so much for watching, and don't forget to subscribe and hit the bell icon so that you can be the first to know when fresh videos are dropping. And please, if you felt that this information was useful, hit that like button. The split second it takes to do that means so much to me and my channel, and we will certainly look forward to seeing you again next time. And until then, stay profitable.